Hi guys, Michael here. In this video I will be debunking the myth about the 16-year dollar cycle, which potentially should destroy the US economy. And at the end I will hop on a trading platform and show you partially how I am preparing for the trading week. So we will check the charts and the macro calendar. So let's start from the myth debunking. Well, I will start with a question. Is the strength of the dollar a good thing? Well, the relative strength or lack of it of the US dollar is often cited as a symptom of countless illness. For example, the economy is weak, so the dollar is also weak. Another example, a large budget deficit causes foreigners to look down on us, which weakens the dollar. There is also concern that the weak dollar will perpetuate further weakening. For example, a weak dollar makes US imports more expensive. And since America is a net importer, this could negatively affect economic growth. Long story short, many people worry that a weak dollar portends weak equity returns. Does it even matter? Well, partially. It is true because a weak dollar makes import more expensive, yes, but does this clearly indicate that a strong dollar is good, or that when we have a strong dollar, people are happy about it? A strong dollar, as was the case in the 90s, for example, is also often blamed as the cause of problems. People complain that a strong dollar makes export too expensive, so nobody wants to buy their stuff, and that has negative consequences for the economy. It is as if people believe that there is some perfect balance between the strength and the weakness of the dollar, and if we, at any given point, are definitely headed for ruin. So this still remains a myth, as it turns out to be very nonsensical. First, currencies are just different varieties of money, and one is not inherently better than the other because there are advantages and disadvantages to a weak and strong currency. Moreover, currencies are not rising assets like stocks. They are commodities. If one is weak, it is only weak relative to something else. So the dollar is weak because the euro, pound sterling, or many other currencies are strong, and vice versa. So let's look at it this way. If you think a weak dollar is economically bad for the US, then strong other currencies must be good for the world outside of the US. Note, however, that since the US's share of world GDP is 25%, the weak dollar should, according to this theory, be less bad for the world as a whole. And the logical conclusion would be that a weak dollar is good, and it is not. A potentially more costly myth is that a weak dollar portends weak equity returns. This is also nonsense. Strong or weak, the relative strength of the dollar does not dictate the direction of the market. Considering the problem as before, if the dollar is weak, it would mean that other currencies are strong. And if a weak dollar is so bad for the US equities, it means that strong other currencies should be good for non-US stocks. If that were true, we could really easily observe how US and non-US stocks would reverse directionally over the decades and be at least moderately negatively correlated. On the other hand, quite the opposite is true. US and non-US stocks tend to move in the same direction. Not always and not to the same degree, but if US stocks rise, non-US stocks tend to rise as well. The same thing happens when US stocks go down. Not always perfect, but enough to show that US and non-US stocks are certainly not going in opposite direction. So lots of people tell you fairy tales about this 16-year dollar cycle that will destroy the US stock market. Regardless of whether the dollar is strong or weak, it has no significant correlation with equities. To give a few examples, the dollar was weak against a broad basket of foreign currencies in 2004, 2006, and 2007, and equities continued to rise. Between 2001 and 2008, it was strong as stocks plunged. The dollar was also weak in 2002 and stocks fell. While it was strong in 2005, the stocks rose. And while it was weak for much of 2009, the stocks surged. In addition, from the first quarter of 1995, the S&P 500 total return index increased for 54 out of 77 quarters. Out of these 54 quarters, the dollar rose 28 times and fell 26 times. It is basically a coin toss. I will end with that. Now let's hop on the platform and check the charts. Okay, and we are in the MetaTrader 4 platform. At the beginning, I need to show you this is my own personal account, my real name and surname, and real money on top of that. So everything that I'm showing you is are the trades made on a real account and with real money. So right now you have available here the current change of my monthly portfolio, but I will talk about that at the end of the month. We will make a summary. If you didn't follow for this project, I'm making a portfolio project with the monthly stocks portfolio, and yeah, based on some strict criteria that I choose at the beginning of the month, and at the end of the month we will decide which stocks to leave in the portfolio, which add, which delete from the portfolio, which trades there needs to be closed. So yeah, if you are into that, follow the channel and ring the bell so you will be notified when this video will come up. Okay, but starting from gold, because in this week we have inflation data from Germany and from Eurozone, and as well as from Australia, if I'm correct. Yes, we have the CPI from Australia on Wednesday night. So it will depend on your time zone. It might be Tuesday evening. Yeah. So it will you will have to check by yourself with the economic calendar. So let's dive into the chart. And firstly, in previous videos, I was talking about this head and shoulders. This is H4 time frame, and I was talking about the move to the upside based on Fibonacci expansion tool. If we measure currently this move to the upside with the FE100 tool, so we will see that this target was filled almost to the pip with the notch, with the shadow. So from that moment would be a good place to be going on a short side, but right now it's a little bit too late, and to be honest, I don't know how far the pullback might go from here, because we already did the pullback over here, and right now we are currently going to the upside. But the thing is that right here we might have the harmonic pattern that will suggest us that the gold will fall again. So I don't know if you are familiar with the harmonic patterns. Basically, they are you can find them when the price bounced off particular Fibonacci retracement levels. So we have here point XA, B on 61.8, C it vary all the time. It doesn't need to have a strict level. It can end at any given point, but the point D, which is most important because it indicates for us the entry level, is most often on 78.6 or 88.6. So right now it worked well, but we have a pullback to this move to the downside. So we'll have to wait what the price will do over here, and either to entry on the short side. So this is the level of $1,810, or we will have to re-entry again at the 88.6, which is a level of 1820. So and to the downside, of course, but we will have to also wait what the charts will show us and what the numbers will be. So of course, if the Firstly, if the CPI readings will be higher, then of course it should help the gold. But the other thing are bonds, which at the moment are yielding a very good interest, and therefore it is not helping the gold because gold is not yielding any interest. So bonds looking right now a bit more attractive to the investors. So yeah, we will have to see what the situation, how the situation will develop. So initial scenario is the move to the downside, and if we are going down from here or from here, the first take profit is at the 61.8 FIBO level. So that is 1790. Yes, 1790. And the second point is at level C, which is 1760. So all this move to the upside was based on this head and shoulders formation. I think I don't need to draw any lines from here. It is very clear that we have the left shoulder head and the right shoulder. And here we have the neckline, which we broke through to the upside, retested, and went upside again. But the first target we were measuring based on the FE100, which was ending here. And the second way to measure the target, measure the distance between the neckline and the top of the head, which is this lowest point. So it is 428 pips from that move, and right here we have a little bit more than 430 pips, but it is in the good distance from here. So I think the scenario with the harmonic pattern and the of course too short the gold right now, to wait for this level or this level and hop on a short is a good idea for this week. And as for the euro dollar, and we need to check, of course, first thing, the head and shoulders pattern, the left shoulder head, the right shoulder, and even we can say two heads over here. And as for this move to the downside, we can measure with the Fibonacci expansion tool. So we get the lowest point, we measure the first impulse over here, and connect it with the retracement. And if we combine that, you can clearly see that the FE100 measurement was respected. We even tried to break it through 3 times, and to be honest, I was about to go long on this breakout to the upside, because as well we also had an hour ago this ascending triangle. Let me draw it better. Here you have the line from the FE100. So that was suggesting the upside move, the continuation, but it didn't happen. And to be honest, I will be waiting as for the H4 candle to be closed to see if it was just a spike, the stop hunt, and then we will go and we will continue the move to the upside, because we see the move is very steep. Or the price will consolidate at those levels, and we will have to look again at to enter at the neckline. So basically we will have to wait what the price will do in this zone and enter on the enter when the neckline is broken again at the level of 1.1607. So that is the scenario as for the EURUSD. Next, USDCAD as well. The same scenario, we can say, head and shoulders, clearly left arm, head, right arm, shoulder, and we have here the neckline. So this is again a 4-hour time frame. If we look for the left side, this is also a very strong support. So the place in which the pattern was created is, I think, is correct. So therefore it suggests it will be valid and it will be respected. So So yeah, entering at the neckline. You know what? This one I will take. Because we are already trying to break the neckline. Now we retest it. Okay. So let's just set the stop loss. So we have 81 pips at add a couple pips to the spread and to the spread and 1 pips for the market noise, and yeah, 2 to 1, so 81, so 160 pips to the upside as for take profit. So risk 2 to 1 on this trade. This is a reversal pattern, so it should at least make 1 to 1. So therefore we could at least make 80 pips from here, which will be the place where potentially I would be taking half of the trade, or maybe move the stop loss at the break even. So that is the scenario for USDCAD, because we have the data from the Canada, the GDP, right? GDP, the interest rate decision, and it is on Wednesday, and on Friday we have the GDP data from Canada. And of course the market sentiment is positive for the Canadian dollar, and as well the oil is helping the Canadian dollar. But I think after such a steep fall from the US dollar right now, we will see at least a significant pullback from this moment, and which is seen on euro right now, which is a bit weaker compared to US dollar. But we can see the CAD is trying to defend their position. So that is as for the USD CAD, and at the end the crude oil. So what we can do with the crude oil, because sky is the limit right now. As for the crude oil, so where to look for potential support and resistance. So let's measure this correction move, and we will see that here we have a 61.8 Fibo level, so it will be it is $85.35 per barrel. So the price from this level should potentially made a pullback, or at least consolidate at that level. And if we are talking about the re-entry the market to the upside, so be sure to follow LiteFinance on Instagram and TikTok, because I am talking about such stuff over there too, and I have on me the overbalance method. So basically this is a measurement of the biggest correction in the move, which repeats itself, and if it is broken, it is potentially a signal for the change of the trend, change of the sentiment, change of the trend direction, change of the sentiment on the market. So let's measure the first biggest pullback, which is this one. Let's measure it to the notch. So you can see we have the first impulse, small correction, another impulse, bigger correction, and from that move we measure. We have another impulse, the place from which the price started to reverse, and we see this level was respected. And again, another impulse, the price bounced off that level, and we see again the level of the range, price range from this biggest correction was respected again. So we could potentially re-enter the market to the upside. The same thing. Another impulse to the upside. The price started to the price made a pullback, and sorry, and we made okay, and again the price range was respected. So let's measure again. Cheese, cooperate. Here we had the smaller pullback, but here again this was smaller pullback, moved to the upside. Again, it was respected. So taking that logic, if we bounced more or less from this level, measure the overbalance, measure the overbalance pullback, the overbalance correction. So more or less, it depends from which level the price would make the pullback. So more or less, that would be the level from which the price should continue the rally. But if we broke this range, this price range, and the price will go deeper, that could potentially suggest that this upside rally is about to end, and it is time to look for the shorts, not the longs. So I hope you learned something from that. I hope this was something useful, this overbalance method. It doesn't work always, but you can clearly see that here on the oil it is. So yeah. So thank you for watching, guys. See you in the comments or in the social trading platform in their chat. And thanks and goodbye.